welcome. You're watching NDTV Profit's special RBI MPC coverage. I am Pallavi Nahata. Now, the RBI Governor Shaktikanta Das, as was largely expected by the markets, decided to keep the benchmark lending rate at 6.5%. The RBI and the MPC have also voted to continue to maintain the stance at withdrawal of accommodation. But for more insights and their analysis from today's MPC, we're joined by B Prasanna, Group Head, Global Markets, Sales, Trading and Research at ICICI Bank, and Radhika Rao, Senior Economist at DBS Bank. So thank you so very much for taking time out for us today.
Thank you, Pallavi.
So, to begin with, what were your quick takeaways from today?
So I think broadly, Pallavi, I think you gave a good introduction. Broadly, very as per market expectations, I would say. And I think the fact that there was no change in policy rates as well as no change in stance was both kind of expected. In fact, the voting pattern at 5-1 was also kind of expected for both the policy as well as the stance change. I think the significant takeaway possibly is the fact that the continued focus on not only the target of 4%, but the fact that it needs to be durably at 4% even after it just touches. So basically, it means that we're not really comfortable with it touching at 4 and then going back up. So we wanted to be durably stay at 4% was one takeaway. And the second, I think, is the reiteration by the governor again that the growth being very good gives them the policy space to kind of address inflation.
Meanwhile, we'll quickly get in our second guest for the show, Radhika Rao, Senior Economist at DBS Bank, while we try and get Mr. Prasanna back on the show with us. Radhika, hi. Thank you so much for taking time out. Quick thoughts on today's policy. Broadly along expected lines, but what were your key takeaways?
Hi, Pallavi. Certainly, I think I think the central bank went into this policy review with a couple of more data points. They had two inflation numbers on hand. They already had a very strong GDP outcome, and also global central banks and their commentary, in the past 6-8 weeks. So based on that assessment, and I think probably the most recent development was the oil prices heading towards the 90 mark globally. And of course, you've also seen geopolitical tensions flare up in parts. So I would think that the central bank's assessment, overall economic assessment, I think they are continuing to be very positive on growth. I think they did see it being investment driven in the earlier assessment as well. At this time, we saw a bit of hint of optimism on consumption also expected to pick up. They have maintained their overall forecast, but if you see the quarterly profile, there's a very slight change in terms of the first half of the year. And in terms of inflation as well, they expected to be at 4.5%. That means still above target. But in one of the quarters, it actually slips below 4%. And that's what the quarterly profile seemed to suggest. Apart from all of this, and I think they have really emphasized, and I think if you see the monetary policy report, which also got released alongside, there's quite a strong emphasis on, weather-related issues and those concerns for food inflation. Again, you and I know that central bank policy doesn't or can't do much for supply side pressures. But of course, the channel that they can make sure spillover doesn't happen is inflationary expectations. And that's why they've spoken about, the warning from IMD about potential heat, high temperatures from April to June. Possibly after that, we could still enjoy a normal southwest monsoon, which would be very important for food grains. So in the near term, to conclude, I think the strong growth above target inflation still very much in place, which outright doesn't tell you that there is sufficient room to ease policy or there is an imminent dovish pivot in view. And I think the other one is, of course, to watch weather. So I think between now and when they meet next or in the quarter after, there are 2-3 developments which I think they're keeping a very close eye on. Perhaps we can discuss this in the next section.
Absolutely. Mr. Prasanna, now that we have you back online with us, I do want to ask you, like Radhika too pointed, we do expect inflation in Q2 to actually fall below target, even if it's just for that one quarter. But at that point, real rates are going to be fairly high. So despite the fact that for the full year, we're still looking at an inflation forecast of 4.5%, that is above target. Do you still pencil in a rate cut, even if it's a modest one of maybe about 25 bips back, in Q2, when inflation is expected to fall below target?
So first of all, Pallavi, I hope you can hear me now.
Yes, I can.
So I think Dr. Michael Patra was making a very interesting point about real rates. It not only is real rates important, but it's also important from what level of expected inflation we are looking at that inflation and the distance that level of inflation has from the target. So when you're having a expected inflation of 4.5%, and then you calculate 2% real rate, it does not necessarily mean it's very high, is the point he was trying to say. So I guess a higher real rate of interest in order to bring inflation down to 4 is required when the current inflation is much higher than the target. And then as we go forward, it comes down. I think that's the point he was trying to make. So maybe the real rate argument needs to be nuanced from that perspective. The other thing is the fact that just because Q2 inflation goes to 3.8, but the fact is Q3 and Q4 again goes back much above 4 to say something like 4.5. I mean, the governor made sure that the market doesn't run away with expectations of big rate cuts because of this fact. And that's the reason why he keeps saying about the durability of the inflation target being achieved at 4%. So I think all in all, I think that's the reason why at the margin, the market might probably take this as a hawkish kind of a policy, primarily because he's not just letting the comfort come into the market that inflation is very well controlled, because we all know that Q2 inflation is going to be lower, and we all know it's also a part of a base effect because momentum of inflation still continues to be good. So from that perspective, I think he's managing expectations pretty well. Having said all this, Pallavi, I think what happens in the Fed will also have a bearing on the way RBI charters its policy as we go forward. He is, of course, not going to say that in so many words. We do make policy for our own domestic priorities, but at the same time, we don't live in an isolated world. We live in a relative world, and what happens to the Fed and what happens to the dollar will have to have a bearing either indirectly or directly into what we also do. So I guess monsoon is one. Going past the Q2 inflation and looking at Q3, Q4 also being close to 4 is the second. And the third is to see Fed actually acting in the cycle behind us rather than ahead of us. I think that's the most important thing that the governor is possibly waiting for. So we are penciling a shallow rate cut cycle, but we are probably moving the first rate cut from August to October due to the kind of the nature in which not only the Fed is moving, but also the way in which the governor spoke today.
Got it. Okay, I have the same question for you, Radhika. Given that the global macroeconomy does appear to be looking up, we have seen fairly encouraging data, not just here in India for GDP, but globally as well. And given the commentary today, do you think there might be a little bit of a chance that the RBI might even possibly, cut rates before the Fed does?
I do think that there is some similarity in terms of the undercurrents that the Fed is facing as well as the RBI facing. I think both are in a situation where growth is strong, and especially in Fed's case, of course, there are many market participants who came into the year thinking there could be a technical recession, soft landing, hard landing. Those conversations were still going on, but both are in a situation where growth is stronger than expected. And I think that's allowing them the headroom to go ahead and, wait it out till the inflation actually heads towards target. On Fed part, I think they've already mentioned that they might not see inflation at their target, but if as far as it heads they're happy with that. In RBI's front, certainly, I think what happens globally is important. But I think time and again, in today's press conference as well, the governor did mention that domestic considerations will be far more important. And I think amongst the Asian central banks, you've actually seen that not many of the central banks actually moved as much as the Fed did. So, when the Fed reverses course, the Asian central banks also will not need to do as much. When we come to the RBI's point, I think the scope of RBI moving before the Fed is rather small in our personal view. We have already expected them to move only in October. I would think the debate would be more towards cut by how much or cut at all, I think, rather than them bringing it forward by any rhyme or reason. I think the other one is, so at this point, look at growth, look at inflation. Both don't make a justification to essentially go ahead and cut rates. And as Prasanna also highlighted from the press conference, it was made quite clear that real rates matter, but real rates matter insofar as also comparing where the inflation is at 12 months from now vis-a-vis the target. So all these points tell you that there are no clear signals of being dovish. I think it's all market expectations, market pricing, and every subsequent meeting that the RBI comes out and does not change stance, does not move on rates, that market pricing in terms of rate cuts continues to get pushed back. So I think to answer your question, I don't think there is any scope of, in our view at least, that the RBI will move before the Fed. I think if anything, they would prefer to be more cautious. And between now and, the next 2 quarters at least, they have an election where they would like to prefer that financial conditions remain stable. Then you've got index inclusion that starts in June, and it happens in a phased manner. So, even then, where the currency is, where rates are, wouldn't matter. And of course, the third would be Southwest monsoon, which also starts somewhere in May to July, August. So all these things are event risks that they're watching out for. But as far as policy is concerned, a very little justification at this point to go ahead and pivot towards a dovish leaning.
Okay, so time for a break now, but before we do that, will the RBI follow the US Fed's path and consider cutting rates? That was the question asked by my colleague Vishwanath during the RBI's post-monetary policy presser. Here's what Governor Shaktikanta Das too had to say. Listen in.
You spoke about the real rates in detail, but the bottom line is you're not seeing 4% in FY25, at least according to your projections at this point in time. There was hope that when the US Federal Reserve supposedly is going to cut rates in June, then the RBI might follow. Are we looking at any kind of any indication of a rate cut this financial year or not? That's my primary question.
You see, with regard to the rate cut this year, I cannot give you a forward guidance. In fact, countries which give dot plots also, the dot plots keep changing from meeting to meeting. So with regard to rate cut or whatever rate action, I mean, let me not say rate cut, but whatever rate action, it is linked to the evolving path of inflation. So on that, I cannot give you any forward guidance. And the other point which you mentioned about expectation linked to US rate cut, I think as I have said on a number of occasions earlier, our monetary policy is primarily guided and determined by our domestic situations. So we do not just follow the footsteps of the US Fed. In fact, if you just recall in the past several months or past few years in particular, I can talk about. I mean, we did our rate cuts. Our rate cut, which we did in 2019, or the beginning of the rate increase, which we did in 2022, they actually preceded US Fed action. So therefore, our policy is governed and determined primarily by domestic circumstances.
Mr. Prasanna, I'll come to you first. So I do want to ask you, broadly, the expectation for the benchmark bond yields going forward is for them to range between about 6.5% to 7%. And what is the figure that you are looking at? Also, can we expect weighted average call rates to also now trade below the repo rate going forward?
So, Pallavi, I think bond yields are going to be between 7 and 7.15 kind of levels till maybe the first quarter gets over. And after that, when the bond index inclusion comes, and hopefully the Fed would either have indicated that they're going to cut very soon, or they have actually cut, then bond yields can slip below 7%. So our range is somewhere between 665 and 7 by the second half of this financial year, and between 7 and 7.15 for the first quarter. And on the question on the weighted average call rate, rest assured that even when RBI changes its stance and becomes a little easy, it's going to make sure that it's going to mop out excess liquidity to ensure that the weighted average call rate does not slip too far below repo rate. So they always have been having an asymmetrical kind of a reaction between when liquidity is surplus and when liquidity is deficit. When liquidity is deficit, they're quite slow to act to give money to the system because their stance was also such. But when liquidity is surplus and it goes below repo, I'm sure they are going to use these multiple instruments to take it out. Not the long-term instruments like OMO sales and all that, but at least the BRRRs and then take it out. So I would assume that it'll be an achievement if weighted average call rate is close to the repo rate. That itself is good enough for the market because the market is coming from a period when there was a stealth hike, so to speak, and the weighted average call rate was about 25 basis points or so above the repo rate itself, which is considered as a policy rate. So I think that's the way to really look at it going forward.
Okay. Radhika, coming to you, I do want to ask you, so, for the longest time, we've had a wide term premium here in the Indian markets. But going forward, considering the broader expectation given domestic and global factors, is some easing on the benchmark bond yields. Is a smaller term premium then going to be a problem, towards maybe the second half of the fiscal year?
No, I wouldn't necessarily call it a problem. I think there'll be two different drivers that will drive two ends of the curve, I would think. The short end, for it to correct quite sharply, you will need quite a clear signal from the central bank on the policy front, and I think we have discussed that in quite detail. On the longer end, of course, right now the curve is pretty flat, but what you do see is, again, there too you need to be, right now you're seeing a lot of inflows, kind of keeping a lid on the yields as well. In fact, there are two-way forces. There's inflows capping up move, and on the downside you've got what's happening globally. You've got the US yields that started the year on a sub 4% footing, and now you've seen them seen quite an increase. So going forward, I think on our focus are not very different. We in fact also expect yields to be, at least the long end of the curve, to be at about 6.95% at best in the first half of this fiscal year. I think in terms of flows, we've already seen about 6-7 billion flows into bonds, front running the index inclusion just this calendar year. And now with those kind of flows, even then you've seen the rupee actually weaken. So the central bank has been very active in absorbing those flows. In fact, in the MPC today as well, or at the meeting, the RBI did mention about the fact that the reserves, because generally markets are questioning now at what point will they stop, in the sense that it's 650 okay, 680 okay, 700 billion okay in terms of the reserves. And I think the central bank made it quite clear that they don't have any target in mind, and it is a function at the end of the day of strengthening your own country's balance sheet, and is also in terms of wanting to minimize any one-sided swings on the rupee, according to us. So coming back on the yield front, I would think that first half, and not so much of movement. I think we barely see it going down to about 6.95%. This is our own in-house forecast. In the second half of the year, we could see a bit more of softness. But insofar as the flows are concerned, I think it is quite clear that the central bank would not want, very strong impact on the currency or on yields just because of the flows. And on the liquidity part of the equation, I think liquidity being relatively kept tight also kind of gels with what they have been talking about in terms of policy transmission. There was a very passing mention in today's review. Much more time was spent on it in February. Keeping excess liquidity in check kind of also aids your overall policy transmission, which continues to happen. And I think it will expedite because you've got this external benchmark lending rate loans under it now almost at about 56-57% of outstanding, so which is increasing, and then MCLRs are basically coming down. So net, yes, to answer your question, I would think short end and long end we will look at two different drivers.
Thank you so much for that, Mr. Prasanna, and thank you so much for joining us, Radhika. That's all the time we have on the show for now. But do stay tuned to NDTV Profit. We have a lot more lined up.